Hello, welcome back to the market forecast. Have you ever wondered how traders make money when market goes up and when they goes down? That's where future trading comes in. In this video, I'll explain what futures are, how they works, and the key concept every beginner should know. So let's get started. So here is what we will cover. What futures are, products offered by future market, the exchanges, how future trading works, leverage, contract specification, and what moves future price. By the end of this video, you will understand the fundamental of futures market. What is future? A future market is a marketplace where participants buy, sell, standardized contract agreeing to purchase or sell an asset at predetermined price on a future date. A future contract is simply an agreement to buy or sell an asset at a future date for fixed price. These contracts are standardized and traded on exchanges. They are used by both investors protecting themselves from risk, and traders look to profit from price movement. The future market isn't just about stocks. You can trade indices, metal, currency, bond, agriculture, energy, crypto, gas, and so many things. Whatever market interests you, there is likely a future contract for it. Futures are trades on regulated exchanges like CME, CBOT, NYMEX, COMEX, and ICE. These exchanges are ensure fair pricing, standardized contract, and secure transaction between buyers and sellers. Now, the main question comes in traders' mind: how future trading works. So, in future markets, a buyer believes price will rise, a seller believes price will fall. Both enter into the futures contract. The contract price changes as market conditions change. Trader can close their position before expiration, and they can make profit and loss according to their price movement. Trading future is a simple. If you think price will rise, you buy. If you think price will fall, you sell. As the price move, your profit and loss change. Most traders close their position before the contract expire. Now, leverage in the futures trading. One of the most important features of future trading is leverage. Leverage allows traders to control a large contract value with smaller amount of capital. For example, suppose a future contract has a national value of $100,000, but a trader has only $5,000, so they can put their $5,000 as a margin and they can leverage 1 to 20s. That's why one of the biggest advantage and risk of future trading is leverage. With relatively small margin, you can control much larger position. This means your profit can grow quickly, but so can your losses. That's why risk management is critical in futures trading. Now, future contract specification. All future contracts are different. They have different sizes, different tick size, different tick value, different point values, different expiration date, different trading hours, different margin requirement, different settlement methods, and so on. Before placing trades, always check the contract specification. Know the contract size, tick value, trading hours, expiration date, margin requirements, and settlement method. This detail determines your potential profit, losses, and overall risk. Here is a perfect example of future contract specification. For example, let's start with number one. Number one, contract size. For the crude oil, it has 100. For crude oil, it has 1,000 barrels for one contract. For gold, it's different. It's 100 troy ounce. For E-mini, it has the index value of $50 for each point up or down. Tick sizes are also different. For S&P 500, it's 0.25 tick. For gold is 0.1. Same thing. Number 3, tick values. So tick value is tick size multiplied by the point value. That gives you the tick value. For example, a tick size of S&P 500 is 25 and the point value is 12.50. That gives you a value of tick size. Number 4, point value. For example, in E-mini S&P 500, one index point means $50. It's different for all contracts. For gold, it is 100. Number 5, expiration date. All contract has different expiration date. Trading hours. So most of the contracts are start trading on 5 p.m. CST and it ends at 4 p.m. CST, but it's different for all other contracts. But most of the contracts, for example, gold, silver, ES, NQ, YM, those are starts at 5 p.m. EST. Number 7, margin requirement. So all future contracts has a different price, different margin requirement based upon the risk. Number 8, settlement method. So there are 2 settlement methods. One is cash settled and second physical settlement. So in cash settlement, settle in cash based on the final settlement price. For physical settle, result in delivery of the physical underlying asset. So every future contract follows this specification. Understanding them helps you calculate risk, estimate costs, and avoid expensive mistake. Never trade a contract without knowing these details. So here is the contract specification and profit losses. For example, in S&P 500, the tick size, the smallest price movement allowed. The value, tick value, the dollar value of the smallest price movement. For example, the tick size of S&P 500 is 25 points and every tick value is $5. Then one tick gives you $5. So 4 whole ticks, meaning 1 point, can give you $20. So this is just an example. So here, the main question is, what moves future price? So successful traders doesn't just watch charts, they pay attention to the news that moves the market. For example, economical data. In economical data, traders look for employment report, inflation data, GDP, consumer spending. In central bank policy, for example, the main things to look for is interest rate decisions, monetary policy, Federal Reserve's announcement, geopolitical event like war, political instability, international conflict, supply and demand. The supplies and demands are important for commodities. Market sentiments, for example, fear, greed, investor confidence, corporate earning,